a lot of gold standing for delivery also. You have hundreds of millions of ounces standing for delivery. And again, there will not be any delivery because there is no physical gold available, only futures contracts that have a value which is massively above the current price. So if you look at the amount of outstanding debt in the world, including derivatives, as I said before, of about 3 quadrillion, and you say that to be a properly balanced system, you should have at least 10% gold coverage against that 3 quadrillion. So in order to have a proper coverage by gold against the 3 quadrillion, you would need, let's say, 10%. Today, there's only $6 trillion worth of gold held by central banks, and that represents 0.2% of the outstanding debt. So if you go to 10%, that means 50 times increase, and a 50 times increase would mean that gold in the $250,000. That's not impossible because it's not gold going up as we know, it's actually the value of the paper money that's going down, and that's going to go down to zero. So there's no reason why gold couldn't go to $250,000.
The financial system is entering a more dangerous phase, according to Egon von Greyerz. He argues that a growing gap between paper prices and physical markets, especially in gold, silver, and energy, is now visible and is the most important issue. Egon von Greyerz, a longtime advocate of wealth preservation through real assets, explains that huge quantities of gold and silver appear to be standing for delivery on futures exchanges, yet the physical metal simply is not there in the size the paper market suggests. He argues this is a warning that price discovery is becoming increasingly detached from supply itself. From that perspective, rising prices are not really about metals becoming expensive, but about currencies steadily losing purchasing power. He also points to the scale of global debt and derivatives as evidence that confidence in fiat money is being pushed toward its limits. In this environment, he sees precious metals as a form of financial protection rather than as a form of speculation today. Now, we present the clips from Egon von Greyerz' interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Whatever happens now is not going to affect the outcome because the outcome is absolutely certain. That means we are at the end of a monetary era, and that era is going to end as badly as all monetary eras. As a matter of fact, it's going to end a lot worse than any other monetary era for the simple reason that this is the biggest bubble in the world, and it's a global bubble. We've never had a crisis, a monetary crisis of global proportions before, ever in history. So therefore, it's going to be worse than it has ever been before. Now, whether you get new news about oil or new news about gold, yes, of course, it does have a short-term effect on markets and on prices, but it's not going to, as I said, is not going to change the outcome. So what is the outcome then? It's a collapse of the monetary system, which means that the money will die, which means money is going to go to zero in value, as it always has done. It's gone down already by 99%, the value of money since 1971, when Nixon closed the gold window. And we're going to go see that final 1%, which is a massive collapse, taking place now in the next few months and in the next few years. So whether the Strait of Hormuz will be open or closed, well, it's already predetermined. This is how to read markets. Markets reach a finale, and we are at the finale now, or at least at the beginning of the end of the finale. And that's when we're going to see more bad news than ever. Just take now, in the short term, what's happening. Airports are closing. I just saw today, Sunday, that Liverpool airport is closing. Spanish airports are closing. Planes are not flying. They haven't got any fuel. And oil is priced at around in the $90. Well, the real price is not in the $90. I've just heard a recent price in the Far East of $280. So the real price is a lot higher than the quoted price for the simple reason that there is no physical oil available for a lot of people around the world now. So prepared for shortages of fuel for your car, of fuel for a home, of fuel for the world's industries and factories, etc. And whatever Trump does or Iran does is not going to change it. The die is cast. So what will this mean? Well, it mean obviously a lot higher oil prices and massive shortages. There were at the beginning of this year oil reserves around the world of about 1.6 billion barrels. That's gone down already by 650 million barrels, and it's going down by another 450 million barrels per month. So we will soon run out of reserves, and when there are no more reserves, that means that the real price will be not the futures price that we see now, which is not a real price. The real price will be what somebody is prepared to pay for a barrel of oil, and especially a barrel of oil that doesn't exist in most places. It would be a lot higher. Oil will go to several $100s. And it's the same with the metals. For example, silver. There are hundreds of billions of ounces of silver that on the futures exchanges that is standing for delivery. But there is no delivery. There's no one who can deliver silver. And at some point in the very near future, and I've talked about this before, silver is not just going to go up back over $100 again. It's going to go to $200, $300, $400, $500. And that could very easily happen this year or even in the next few months, because we're very likely to see a panic. And it's the same in gold. A lot of gold standing for delivery also. You have hundreds of millions of ounces standing for delivery. And again, there will not be any delivery because there is no physical gold available. Only futures contracts that have a value which is massively above the current price. So that's just in these markets. And you can imagine what effect this will have on financial markets. You look at global debt, as I show here on this pyramid. Global debt is probably around 360 trillion. You add to that unfunded liabilities, and you add to that outstanding derivatives, which I estimate to be the real outstanding derivatives is probably around $2 to $2.5 quadrillion. The Bank of International Settlement is giving the totally wrong figure here. So if you add the outstanding derivatives and the outstanding global debt and outstanding unfunded liabilities, you get to around 3 quadrillion. And that 3 quadrillion is debt or quasi-debt today, and it will turn into real debt. And what will that lead to? It will lead to massive money printing. And as you can see here, you have King Donald is his mistress, Madame de Pompadour pal, of course not his real mistress, but from history, Louis XV and Madame de Pompadour, when they lost the war against Prussia in the mid-1750s, Madame de Pompadour said to the King, Louis XV, after us the flood. They knew that this was the end of an era for them, and it was France was going to have real problems, financial problems, also of course leadership problems, because you got the revolution a couple of decades later. So, and this is what we're going to see in the world here now also. Leaders will be thrown out, wars will be lost, money will be printed, but it'll be worthless money, of course, and therefore the value of money will go to zero, as it has in every monetary era throughout history. So you can see the people here drowning in debt, because there'll be, as I said, unlimited amounts of money printed to save the world, but you can never save a world which has a debt problem by printing more debt. So the consequence will be that money will become worthless. So if you look at the amount of outstanding debt in the world, including derivatives, as I said before, of about 3 quadrillion, and you say that to be a properly balanced system, you should have at least 10% gold coverage against that 3 quadrillion. So in order to have a proper coverage by gold against the 3 quadrillion, you would need, let's say, 10%. Today, there's only $6 trillion worth of gold held by central banks, and that represents 0.2% of the outstanding debt. So if you go to 10%, that means 50 times increase, and a 50 times increase would mean that gold in the $250,000. That's not impossible, because it's not gold going up as we know, it's actually the value of the paper money that's going down, and that's going to go down to zero. So there's no reason why gold couldn't go to $250,000. But it's a meaningless figure, because the real figure is that gold will maintain its purchasing power and probably do better than that. What's also going to happen in the next few months here is that all paper asset markets will fail. Stock markets will start a long-term secular bad trend, and stocks will collapse, and that will start in the next few months, could be earlier. So will bond markets. Bond markets will come down dramatically, because no borrower, whether a sovereign or corporate or private, will be able to afford to repay the debts. Bond markets will crash, and interest rates will go up to at least the 20% or around that level, as they were in the end of the 1970s and early 1980s, and I remember it well. And so don't hold bonds, don't hold stocks, don't hold property. Property is leveraged and is a bubble. You should hold hard assets, and of the hard assets, of course, gold and silver are the premier assets to hold. Hold them in physical form, hold them outside the banking system, hold them in the safest vaults in the world that you can find.
Egon's outlook takes on critical urgency as he links metals to the broader monetary system. He warns the world is careening toward not just a normal correction, but the very endgame of an era built on debt, leverage, and paper promises. In his urgent assessment, fleeting headlines may jolt markets, but cannot reverse the dangerous trajectory now unfolding. This is why his predictions take on a dramatic and urgent tone. He insists gold could soon reprice far above what most investors believe possible, as the core move will reflect catastrophic destruction of paper money value, not just a typical bull run. For silver, he urgently warns that if panic erupts and physical shortages become clear, the price could skyrocket beyond $100 and rapidly pursue $200, $300, $400, or even $500. Let's get back to the interview.
Inflation is not prices going up. That's a misconception. People don't understand that. Inflation means, of course, which governments will never tell you, that they are destroying the value of the money by printing unlimited amounts of it. And of course, if you print something and call it money and think it has a value, you're totally wrong, because it has zero value. So inflation is the value of money going down, not prices going up. Of course, the consequence of the value of money going down means that prices, as the consumer sees it, prices are going up. But it's really the governments that are destroying the value of money. Now, I've been telling my colleagues for many years that we haven't started yet in our business. We have a big business all around the world. We have investors from all around the world. But remember that the gold as a percentage of world financial assets is still 0.6 or maybe 0.7%.
Yeah.
Nobody owns gold. Nobody owns silver.
Yeah.
And this is why, with absolute certainty, you can say that this has only started, because that percentage will at least go to 5 or 10%. Of course, it will be helped by also stock markets and other asset markets coming down. But nevertheless, a lot of people who don't own gold or silver today will buy gold and silver, and it will become a much bigger part of financial assets. And therefore, in my view, the gold price and silver price will go up by multiples, many times. You can use different criteria for arriving at the value of gold or silver, but the thing is, Kerry, and I made that clear some time ago, you valuing an asset in the form of another asset which is going down by the day, you're just making yourself look good. It serves no purpose to value it in a falling dollar or a falling pound or a falling yen or whatever. That's not the way to value it. I said jokingly many times in speeches, and you should not value it or in articles in paper money. You should value it in chickens or cows.
Yeah, you said
value
that.
Gold in chickens or cows.
Yeah.
And I said that, but it was serious, but I didn't actually look at the numbers initially. And then I started looking at the numbers and then came to the conclusion that a cow has basically cost between half an ounce and 1 ounce of gold for 5,000 years.
Okay.
And I showed, and I've shown graphs of that. I think mainly in my videos. I think I do very few articles now. I do mainly YouTube videos.
Yeah.
So that it's very clear. A cow has basically been stable purchasing power for 5,000 years. So that means that you instead of buying gold, you can buy a cow. The problem is you can't
keep the cow.
You have to keep it somewhere, and you have to feed it, etc. And it doesn't fit into an apartment. But it does show that that there are things that maintain the value, and of course, food is an obvious thing, and a cow is obviously even more obvious. So that's extremely interesting. I find that you actually can value it in something real, and therefore, yes, if you are a farmer, you're always going to survive because you have food. At the same time, of course, there's global pressure on commodity prices, and farmers have had problems surviving. But now commodity prices are now turning up. So I think, and the value of a cow will go up as much as the value of gold or silver, in my view. Now the move, because of nobody owns gold, nobody yet, and the acceleration of the decline of the value of money with the increased printing and the increased debt, which is now necessary, which is because it's the only solution that central banks have. That's the only way they can try to make this world survive. But as we know, you can't solve a debt problem with more debt. But there will be a lot more money printing. There'll be a lot more inflation, and gold and silver will reflect that. In real terms, it might not go up that much. It might be that it still probably keeps to the half an ounce to 1 ounce for a cow, but that's fine. At least you have maintained your purchasing power, because 99.9% of the people will not, because all they will hold is paper assets and paper money, and that will sadly lose virtually all of its value. This is why we're begging people, not for our sake, but for your sake, have a little bit of reserve assets, have a little bit of precious metals. Sure, if you have it in the form of cattle or cows, etc., that's fine too, but that's only for a minority to be able to do that. So I am absolutely convinced that we have only seen the beginning of the rise of the precious metals, because we have only seen the beginning of the collapse of the value of money. And therefore, valued in paper money, gold and silver will go up by multiples, and they could be very, very big figures. As it is totally meaningless to say they'll be worth $1 billion or $1 trillion or whatever an ounce of gold, like in the Weimar Republic. It could be, but it means nothing. Instead, look at it from a purchasing power point of view. That's the only thing you should. So yes, absolutely. It's not too late. It is absolutely not too late, in my view, to buy gold or silver. And we're saying that time and time again. People, sadly, we see it ourselves. People love buying high. People love buying on good news. Good news for the metals, and people get scared as soon as it corrects a little bit, and then they wonder if they should sell. We have clients who are long-term wealth preservationists, so at least nobody sells, but we get always much bigger inflow when the prices are going up, because new people are coming into the market, and that's fine, because, as I said, prices are going to go a lot higher anyway. So even if you buy not on the pullback, but on the price going up, that's going to be fine, because you're going to see so much more of price rises coming in the metals in the coming years.
The bigger message in Egon von Greyerz' analysis is that shortages may not stay limited to metals. He extends the same argument to oil, saying quoted prices can become meaningless when physical supply is unavailable where it is needed. In that kind of environment, the market stops functioning as a clean pricing mechanism and starts behaving like a scramble for scarce real goods. That is why he believes the coming phase could be chaotic across currencies, commodities, and financial assets simultaneously. His view is uncompromising. Once trust in paper claims begins to break, investors will stop caring about official valuations and focus instead on what can actually be delivered. Gold and silver, in that framework, become monetary anchors during a period when debt instruments and fiat systems lose credibility. Whether one agrees with his most aggressive forecasts or not, his core warning is clear. The risk is no longer just inflation. It is systemic failure in how markets price money, energy, and tangible assets. Share your thoughts on Egon von Greyerz' analysis in the comment section below. If you found this video informative, please like, subscribe, and turn on notifications so you never miss our latest updates.